Hello everyone, Chad Mays here with CEM Commercial interviewing Ryan, who is with one of our many capital sources. So Ryan, you specialize in stated income and stated asset programs. So can you do like retail space, automotive, office space, warehouse, self-storage units, and mobile home parks?
It's funny, we can do all those, and not only that, but we look at them all in the very similar tier risk aspect. So yes, we do.
All right. Do you only go by debt service coverage ratio?
Well, it is true that commercial lenders look at the value of a commercial property is based upon the income that it produces. However, not every property can do that. In some circumstances, a property is vacant. In others, borrowers run their business out of the property. And so for those similar situations, their property may not debt service out. And so in that case, we're very unique in the sense that we'll look at it outside of the income producing aspects of a property. We can look at it from a sales approach and allow a business owner to actually do financing on a deal that all other lenders would not.
And combined loan to values, how high can you go with combined loan to values?
Combined loan to values, we can go up to 90% on owner-occupied properties. That can be a 5-unit apartment complex where the owner actually lives there and sleeps there. Also, if it's a retail space, for example, if they run their business out of that location, that is actually gives us an ability to say, well, there's a little less risk there because they actually run their business or they live out of there, and we can give them up to 90% CLTV, which is unbelievable. On a purchase deal, what that would mean is any form of secondary financing that is reasonable, not a balloon note in a year or two, but it could be secondary financing from the seller, paid off in regular terms, and we'll allow that.
Okay. What are your limitations on cash outs?
Very little. It has to be reasonable, but as far as cash outs, we just expect that it would help build the business, help the business grow. It can be used to pay off tax liens. It can be used to buy inventory. It can be used to hire somebody to help manage the business so the business owner can have a little more time on their own. It can be used to cash out to purchase other property. Options are endless and much more acceptable through our means versus a bank.
Okay. You mentioned permanent financing in the introduction video.
Sure.
How does that work with your programs?
Well, I consider it permanent financing because we're not a balloon note like a bank is or like hard money. We'll amortize anywhere between 15 to 30 years, and that could be an adjustable rate note, but at the same time, it's not a balloon. And they also have the option of getting a 15, 20, 25, 30 year fixed rate loan.
Great. Thank you, Ryan.